So next, we're going to be speaking with Mr. Chris Atherton. So Chris Atherton is the Chief Executive Officer and President of EnergyNet. EnergyNet is a technology-enabled upstream oil and gas asset acquisition and divestiture platform specializing in auction sales, steel bid transactions, and government lease sales. Chris has been part of the EnergyNet team since 2002. He's been actively involved as the firm has completed over $7 billion in transactions, including sell-side mandates from thousands of exploration and production clients. Chris leads a multidisciplinary team of 50 professionals specializing in engineering, geology, land, technical, business development, marketing, IT, and administration. Chris has 20 years of experience in the energy industry. He graduated from Texas State San Marcos with a business management and marketing degree. Prior to EnergyNet, Chris worked at Enron Corporation in Houston, Texas. Chris recently served as the chairman of the Wildcatters Host Committee for the Texas Alliance of Energy Producers. One thing, he recently also served as the chairman for the SPE Gulf Coast Section Business Development Study Group for 3 years. It's another thing he's doing. He's also active member of IPAA, Texas Energy Alliance, Adam Houston, Adam Permian, and Houston Producers Forum. Chris holds his Series 30, 39, 22, and 63 SEC licenses. And so I'm just going to, I did go over that quite quickly, but for those folks who aren't involved in various different organizations, you just heard Susan, how she talked about being involved. You heard her bio. I want you to start to kind of take notes within yourself and ask yourself, well, why are these successful professionals in these organizations? What is it that they're doing? What is it that they're getting out of it? And just to touch back to Susan and remember how she talked about her network at SPE being very valuable to her when she moved roles. So, Chris, I'm going to start with, so you came from a marketing business development. How did you get into the industry? What was your path into the oil and gas industry?
Yeah, actually, great presentation, Susan. Great points. Thank you, Mark, and NeoGeos, and Casey and Josh for putting all this on. When I graduated college, I graduated May '99, marketing degree, and essentially went and worked for Enron at a time where it was a high-flying company and a great place to work. And that career plan didn't really pan out for me. I had to pivot, as they say, you got to pivot. But yeah, so I started with EnergyNet in 2002 as a way to at the time I think I was just kind of too dumb and hungry and poor to know that it wouldn't work. But it was like go find people and ask them to sell their oil and gas assets through your online platform in 2002. So I would go and visit with people my father's age, and we're gonna take your assets that you don't want, that aren't as valuable to you anymore. We're going to expose them to a lot of people on the internet, and they're going to buy it. You're going to get a great price. And they would just say, "The door's over there, young man." So it was a tough start to go with, but it's been a great ride since.
I mean, talk about it. You're CEO, so talk about a ride. Okay, so tell us a little bit more about EnergyNet. And how does your company fit into the oil and gas upstream acquisition and divestments?
Yeah, of course. So in the oil and gas industry, globally, or especially in the United States, companies are buying and selling assets really all the time. There's probably back in the 80s, there began roles for that position, the acquisition divestiture manager, the business development manager. So all these, major oil companies, super independents, publicly traded companies, private equity sponsored companies, privately held companies, individuals are buying and selling oil and gas assets all the time. So what EnergyNet does is we serve as a marketplace, a two-sided marketplace where we are putting buyers and sellers together and running competitive bid processes for oil and gas assets of varying sizes. So in the beginning, we would one company's trash is another's treasure. There's a big food chain in this industry, and a company may drill a bunch of wells in South Texas. They were big hits. They produced a lot. but now it's 7 years later, and it's not the glory's gone. So they want to sell those assets to another company and take the money and put that into another high-end tax project. So that's what we help them do. We have about EnergyNet now has about 40,000 registered users. So we work typically on the behalf of a seller client, owner of oil and gas assets. And what we do is create a comprehensive data room, engineering, geology, land, title work, financials, ownership, and then we present it to the widest possible audience and of accredited, financially qualified investors. And then if they like it, they evaluate it, and then they may choose to bid on the asset. So think of it as to get the highest price for the property, you typically want to have a lot of people knowing about it, not just one. I guess one way to answer the question of kind of what EnergyNet does is, I would say that the question of, I wonder who's going to pay the most for my asset. We work to answer that question.
Okay, so and one of the main reasons I wanted to have you on here is because of that career path. You started at the bottom, and now you're CEO, and you're relatively young. And tell us how, and I like how you started the story with, you would go in and into however many years ago that was, and you had the technology platform. So tell us what the market looks like now with regard to having a tech platform as opposed to when you first started. People didn't obviously take you seriously. Are they taking you seriously now, and how has that changed?
Yeah, of course. Technology has moved in our favor in the 20 years we've been in business. But nowadays, the decision makers at the companies, at the oil and gas companies, at the private equity sponsors, they understand and see that there is a technology-enabled way to divest of core or non-core assets where you can utilize and leverage and harness an internet-based platform, a technology-based platform to showcase the opportunity, the deal to a large universe of potential financially qualified buyers, get them to compete over it, and then that's going to result in the best deal for you as the seller. So I guess from the seller's point of view, we provide them this huge exposure and competition to the full marketplace. We have 40,000 bidders, everybody from ExxonMobil to all the publicly traded companies, all the privately held companies are registered, qualified bidders and sellers on EnergyNet. So they're using the platform to trade their assets. I guess the more traditional way of doing a deal would be like, hey, Mark, you have this asset in South Texas, and I'm interested in buying it. I'm going to offer you X price for it. Well, that's great, that's great. But I probably have a reason to make an unsolicited offer for your asset to try to acquire it. But for you, you don't want just my one offer. My one offer may be high, low, medium, bad, good, ugly. It doesn't matter. You want to see give me 15 offers, give me 20 offers, and then I'll decide what I'm going to do. I may not even sell these.
Sure. And so, based on what's going on with COVID now, how is your and I'm asking you these questions because you're an online platform, you're a tech business in oil and gas. How's your business been doing?
With COVID, with the shutdown, I think the whole oil and gas industry is tough, and then having some hardships to face. Our deal volume has held relatively steady. We've had 150 to 175 individual transactions per month. The value of those deals, what used to be a $10 or $20 million deal in 2017 or 2018 or 2019, maybe a $5 million deal now, a $10 million deal now. Well, the good thing is, that's a function of price. That's a function of upside and acreage not being as much or valued as much as it once was. But it's also the buyers are there. Buyers are still participating. Transactions are still getting done. The world's been turned upside down. 2019 wasn't a great year for oil and gas, especially in the shale business. Conventional was all right. Global was all right, but U.S. domestic shale business was kind of on the ropes in 2019, going into 2019.
Sure. And then, so we had a question from, I guess, May. similar to one of the ones we prepared. What's going on with upstream acquisitions and divestitures so far in 2020?
It's historically low right now, and I think there's been $3.5 billion in assets traded by all companies, buy and sell. And really the function of this is a couple of different reasons. A lot of the publicly traded independent oil and gas companies have just a huge debt load. They have a huge debt load. So different companies, you may look at their assets and they have great assets. You'd really like to own those, but it's like they have this huge like if I wanted to buy your house and then you happen to have like a $2 million debt on your $200,000 house. That's what a lot of these companies have. They took on so much debt because they had easy access to it, but now they can't sell because they owe so much. So many of those companies are going to unfortunately have to go through a restructuring process, a bankruptcy process, and the assets will likely be sold after that potentially. I would say, I think the majors, the Chevron, Exxon, Shell, BP, and down to Conocos and EOGs are kind of, they're going to be the survivors out of this. They're not going anywhere. But I think they're not chomping at the bit to buy assets or buy companies right now. I think they're waiting for more blood in the water.
Fantastic. Great answer. And so this is a question from, I'm just going to keep it flowing and casual, from Henry Daw. So it's a relatively long question. Why are we not seeing a lot of divestiture in the Permian? Point one. Also, shale development has proven to be expensive. The industry is broke. They are not making money and can't continue like this. We probably won't see $100 oil again in the short term, but even if there was an increase in oil price, developers will rush to pump more oil, which is self-destructing. Where do you think shale development is going? Permian is expensive. Where is it going in the low price environment? So I'll just recap.
Yeah.
Where do you think? Okay, you got it. Fantastic.
Yeah, I mean, a lot of sellers aren't selling right now because it's an inopportune time to sell because of price. When prices are $40 or $35 or $30 or $45, the memory of $50 or $75 or $80 is too fresh in their mind to know what that discrete asset used to be worth. So a lot of sellers just say, if I don't have to sell now, if I'm not forced to sell now, why do it? I would say that there is kind of a misnomer or a fallacy in the market of a fire sale. And what I mean by that is that nobody's selling assets for fire sale prices. I mean, if in our process, for example, if we take an asset in the Permian, it's a good solid asset, we expose it to our universe of 30,000 or 40,000 buyers, and maybe 500 or 600 access the data room, 100 sign a confidentiality agreement, 25 submit bids. We do another round of negotiation with the top 5. I mean, nobody's getting a steal for that asset. That's what the asset's worth right now. It's just happens to be $40 oil and not $80 oil. And if you want to go back and sell your asset when it was $80 oil, then good luck with that. I mean, that's just not the situation right now. Andre's other question, shale, the industry got in over its skis a little bit, I think. The number of wells per location, the EURs of each well, the type curves of each well, it was essentially, I have this square of land here that I just bought for $50,000 an acre, and I'm going to put 64 wells on that. They're all going to produce the same, and they're all going to produce this massive amount, and they're going to cost $10 million to drill each. That math just didn't pan out. Those were, we have what's called a parent-child relationship. You drill one well, 3 wells surrounding it, 6 wells surrounding it, are not as good as the first well that was drilled. So, and many of those companies, those same companies were, their finance, their capital structure is predicated on it working the way they said it would in 2017 or 2016, and that's just not how things panned out. So those companies are in trouble. The shale work, it can in the tier 1 acreage, probably not the tier 2 or tier 3 or tier 4 acreage. I think some of that will shake loose. Why are there not more assets available for sale in the Permian? If you don't have to sell, people aren't selling right They would wait for a sunnier day. There's been people waiting for sunnier days since 2015, and those necessarily haven't arrived. But I think we will see more assets come to market as things, the market and the commodity price stabilize.
Great answer. Thank you, Chris. Thank you for the question as well. And please submit your questions, and I will ask them as they come along. So what are some of the drivers or motivations that create an active A&D market?
Yeah, no, that's a good question. So I guess think of it, I mean, most people would say, what's the name of this this podcast, this seminar? Show me the money, right? Show me the money. That's why I'm selling, or that's why I'm buying. But there's more motivations to that. There's more drivers to that. There are many times a company is trying to grow production. They want to grow their barrels per day of production. They want to grow their reserves, what they have in the ground, what they can produce. They want to grow their acreage position, what their inventory is like. You also have, companies that that are a single basin, but they would also like to, move into other basins to have some diversity. A couple of years ago, we saw the opposite of that, where companies, were maybe multi-basin, and they sold off everything else. They sold those assets and became a pure play Utica player, or a pure play Delaware Basin player, or a pure play Haynesville player, because that's what the market and the investors demanded. They wanted to, instead of having a company like Devon that has, great assets in multiple areas, they wanted to kind of pick and choose their own portfolio. They wanted to have parsley in the Midland Basin. They wanted to have a different company in the Delaware Basin. They wanted to have a different company in the Utica, or a different company in the Haynesville. And they wanted to create their own. We'll see that the pendulum may swing back, and it may be better for companies to have a diverse portfolio of assets globally, domestically, Gulf of Mexico, shale, conventional. I think that will likely come back in favor as the wonders of shale have play out.
Interesting. So who are the participants in the market? Who's selling? Who's buying? How do different types of buyers and sellers behave? That's a good question.
Well, I would say that the way we kind of look at our universe of buying and selling participants, and one thing that's unique about us and kind of what our company and really acquisitions and divestitures in general, and kind of alludes to what Susan was talking about, is we sit in kind of the middle and have to deal with major oil companies, private equity sponsored companies, family owned businesses, individuals that are just, they raised capital themselves. They're wanting to start businesses, oil and gas companies. So you interact with all these different companies that have all these different competing interests, or, we're a Bakken player, or we're a South Texas player, or we only, participate in Oklahoma deals, or things like that. So, but the way we see it is there's publicly traded companies, and then we would kind of categorize those as in the majors, Chevron, Shell, BPs, ExxonMobil. They have a role in the marketplace. For our market, they are typically selling non-core assets. So they used to have this great field in East Texas. It was a haymaker in 1950, but now it's not so much. May still be a good asset, may still be a $50 million asset, but it's not for them anymore. So they sell it down the food chain to a lower cost operator that can strip off the gold-plated, everything on the field and operate at a cheaper price. The next level down in the publicly traded companies are kind of the super independents and large caps, the Devons and EOGs and Oxys and ConocoPhillips and things like that. And that gets smaller down to $1 billion companies, less than $1 billion companies. Those companies are kind of, should they sell to a larger independent? Should they diversify? Should they find a new play like Petrohawk did, or different companies like that kind of transform themselves through exploration? And then below that, you have the small cap and mid cap publics. Those guys are really struggling now. They just don't have access to capital. These are publicly traded companies that their market cap is $100 million or $200 million. That used to be, a couple years ago, were probably $2 billion or $1 billion. The next level, there's a big tranche of market participants that are private equity sponsored. So they got commitment from NCAP or Kane Anderson or NGP or Denham Capital or Quantum or others, and then me and you, we go into to one of those guys' office and we say, well, here's our plan. Here's how we're going to differentiate ourselves from everybody else. Here's how we're going to make money. Here's why we're unique. Here's what our special skills are. And give us $100 million. And they say no. So we go to the next guy and ask them to do the same pitch again. So there's 500 companies out there like that right now that have done exactly that. Then there's the privately held companies, the Hillcorp, Citations, Anschutz, that are have been generational. They have their own game plan. They're usually more long term in their investments. They're not worried about next earnings call in the next quarter. The private equity sponsors are typically trying to build a product that a publicly traded company will want to buy. The goal of the private equity sponsored company is to build a product, whether it's in Delaware Basin or Haynesville or Arkoma Basin, that some other bigger company is going to want to buy, and then you get a big payday. You're not doing a private equity sponsored deal to survive or to operate in the assets forever. And then there's smaller guys. Most of the smaller guys typically are more conventional. They do more conventional drilling because they can buy production and you can work over those wells. I kind of call it the law and order. If oil and gas is a TV show, Law and Order is very formulaic. The TV show is, they're going to buy assets, they're going to do workovers, they're going to optimize production, they're going to reduce OPEX. It's just going to be kind of a TV show. They're going to do it over and over and over again. And that can be a good business. It may not turn you into, or it may not turn your company into $1 billion business in 4 years, but you can have $1 billion business in 30 years or 40 years doing that. And there's individuals that buy and groups that buy non-operated working interests. There's groups that buy. There's a big market space for minerals and royalties. There's a very active market of buying minerals and royalties.
Okay, yeah, fantastic. And so, if the last tier was Law and Order, what would the first tier be? Star Wars?
I would say Game of Thrones, typically.
Oh, Game of Thrones. Okay.
But even that is that would be like the Delaware Basin or something where you have acreage going for $60,000 or $80,000 an acre. Unfortunately, that hasn't panned out. There's some great companies that have some great acreage in the Midland and Delaware Basin. And that's where a lot of companies were focusing. Changing their complete strategy and becoming QEP resources, for example, SM Energy, for example, becoming a pure play Permian Basin company and selling off anything that wasn't there. But with the low cost of a barrel for oil per day these days, with some math errors, if you will, on how many wells could be in a given section and produce the same amount. Some of those companies are having to rethink their plans.
Fantastic. Good answer. Very good answer. Are transactions getting done? How does it compare to 12 or 24 months ago? And can you describe the bid-ask spread?
Deals are getting done. I think sellers are somewhat reluctant to go to market. They're reluctant to put their deal out there, to go through the effort and not get what they want. I think most sellers would be surprised, and what we're experiencing is that because there's fewer assets on the market, because there's not as much capital available to buy those assets, that the deals sub $100 million are getting a large number of bids, and because of that, they're getting a relatively premium value in all things considered, and kind of how I mentioned on the fallacy of the fire sale, if you will. If an asset is offered by a major oil company or a publicly traded company, and they have 20 offers on it, I mean, nobody's really getting a steal. So most of what we're seeing is that there are some tire kickers, if you will, or some people that are lobbing in kind of lowball offers. But the people that really want to own the assets, they have pressures upon them as well. They have investor committees, or they have a board of directors, or they raised money from someone saying, we're going to go buy assets in this down market. So they have pressures on them to get a deal done. And what we see is that they submit their offer. They're in the top quartile We go back and visit with them again and kind of do a round of pencil sharpening to get maybe a best and final offer. And they're getting in, they're in a range and they're getting deals done. The deals are getting done. Not all of them. There are deals, that have substantial lifting costs or operating costs, or the acreage is tier 4, or we're just not as good, and they're not getting much value, if any, for the acreage or for the upside potential, but they are getting full value for the production. The bid-ask spread is another interesting thing, because I think a lot of people think of, like, you have one bidder here and one seller here, and they can't meet. They can't meet. But what's really happening is you have one seller here, but you have like 20 offers coming in from this way, and this is the seller that's saying, like, no, not enough, not going to sell. But if you have 20 or 30 offers, it's the bids ask spread. I mean, the seller is asking for a specific price, but the market conditions aren't necessarily defining that. So they are getting full market value for their asset. It just may be an inopportune time to sell if they don't like the price of oil is $40 a barrel. I think you're muted, Mark.
So this is a question from May. Hypothetically, what asset, oil or gas, conventional or unconventional, downstream, upstream, or midstream, and where, domestic or international, would you invest $10 million? Sounds like someone's got $10 million to invest.
Game show now. I would probably invest in a oily basin that was historically kind of long life. So East Texas, or maybe the Central Basin Platform in the Permian Basin, maybe Wyoming. What I don't want is necessarily to buy a shale well, a producing shale horizontal well that's on an 82% decline. What I would like to do is spend my $10 million on something that has a very flat decline, where I have full rights to the acreage that maybe technology and geology catches up with me, and I find some serendipity. I think that would be a safer bet for $10 million to grow it over time. And that would, I'm akin to upstream, which I don't know as much about, midstream or international.
Nice. I haven't heard anyone use the word Ken in a very long time, so I like that. Fantastic. Okay, so when companies are considering putting an asset on the market, what factors do they typically take into an account?
The companies are always kind of looking at their portfolio and saying what makes sense, what value can we get for this. Sometimes they want to rearrange their portfolio to be more gas heavy, or they want to rearrange their portfolio to be more oil heavy, so they'll sell the assets that don't fit that. It may come down to operating costs. They have high operating costs for certain assets, so they want to sell those to someone that can operate those as at a lower cost. But the factors that go into selling it, they're looking at the production level. What most buyers and sellers in the market tend to agree that for the production, for the barrels that are coming out of the ground today, that will be, that you can kind of forecast for the next couple, 3, 4, 5, 6 years, they think that they can get together on a price on that. Usually where deals break down is where a seller values the upside, the future development, more than a buyer would. That's kind of so if there's $10 million of production and the seller thinks there's $10 million and I think there's $10 million, we can usually get a deal done on the production level. But if there's upside development, if there's 30 more wells that can be drilled, or there's behind pipe locations, or uphole locations, that's where the work for our companies like us come into play, where we're trying to showcase that value and show you how you unlock it, and show why you should pay for it. So I would say, most of the trying to quantify the upside of a potential deal is a big factor in if a company chooses to sell or not. There's some companies that will say, we're not going to put any more money into this field right here because we have better places to put our money. There may be upside there, They may want to get some value for it, but they're going to sell it down the road, and get a good price for the best price they can at the time. They're going to take that money and put it into a more high impact project. Some people, they don't have the other high impact projects. They just want the one high impact project, so they're willing to pay a premium price for it.
Fantastic, good answer. Quite a few oil and gas companies have filed Chapter 11 bankruptcy in 2020 so far. What happens next, and what are the implications for A&D markets?
Right. So you're hearing Chapter 11 bankruptcy is just about every day, or every week at least. Chesapeake, Sanchez, big companies, Whiting, companies that have been around for a very long amount of time are filing Chapter 11. Some are filing Chapter 22s, as they've already filed Chapter 11 once, filing again Chapter 29s. They've filed 2 Chapter 11s and Chapter 7. Fun math like that. I don't think we've seen any Chapter 33s yet. But these companies essentially have too much debt. They took on too much debt. They were lent too much debt, and now they can't pay that. They can't pay their interest, or they become insolvent, or they cannot pay their debts that they're owed, so they have to restructure their debt. But with the companies out there like that have not filed Chapter 11, those are essentially kind of zombie companies. If they haven't filed Chapter 11 and restructured their debt, they just can't really do anything. Their lenders aren't getting paid, and they don't have any right to sell the assets or do anything because they're selling something for $7 if they owe $10 on. So as these companies restructure their debt and resettle their capital structure, they will be able to do deals, and they'll come out of it on the other side. Some of them will liquidate. But what we've seen, I guess, compared to the 2015, 2016 downturn, there was probably 75 or so bankruptcies during that time frame. Many of those companies essentially just said, equity owners, you own stock in my company, that's worth zero now. The people that I owe debt to, you're now the equity owners. So that the debt was equitized, and they just came back, continued drilling wells, continued operating wells, took on more debt in some cases, and they were back off the races hoping for a sunnier day. This time around, we're seeing more what they call bankruptcy 363 sales, 363 asset sales during the bankruptcy process. And that means that the lenders are saying, we would rather take the money now than kick the can down the road and hope for better days. So I think we'll see more of that. Templar, for example, recently did a 363 sale, and they had a buyer, Presidio, buy their assets for $91 million. So assets are going to be owned by Presidio now. Templar is going to go away. The money from the proceeds of that sale is going to get divvied up for the lenders of Templar, but we're seeing that more and more.
Okay, Chris, this is from Alan Bertain. Alan was actually a mentor of mine as well early on in my career, and I still continue to watch the things that he's doing. Great guy to connect with folks. So this is Alan Bertain. Chris, can you talk about the current ranges of NPV, $10 per BOPD, and dollar per barrel, if you like?
Sure. What we're seeing is we've heard rumors, or we hear rumors that assets are trading for, a net present value of discounted at 20% or 30%. We're not seeing that. We're seeing deals that are quality assets trade between a net present value of 10% to about 15%. Usually those buyers are kind of going above and beyond to showcase to the seller, to kind of show their work on how they're evaluating the assets, and they're saying, here's our PV10 number. What we see is a discounted, here's the ultimate economic recovery. Here's how many dollars this asset will be worth over the life of its existence before it just goes to nothing. And here's that discounted at 10% to take into account what it should be worth today. So they're not all trading like that. Some have more hair or more skeletons, and they're not trading like that. So I would say kind of in between that net present value 10% to net present value 15%, and what that equates on a dollar per barrel per day, like a flowing barrel per day, is probably about I would say $30,000 per flowing barrel per day. So if you had a net, that's a net barrel per day. So if you had, a well that was producing 10 barrels a day, you could think that that's going to sell for, $350,000, $300,000, somewhere around that range.
Interesting. Thank you, Alan, for your question. Okay, so Henry Darb, back to the game show questions. NPV 10 to 15, which basin and at which price, and how much for PUD barrel?
I think most of the production is essentially trading at kind of PV10 to PV15 in most basins. Oily basins, I would say, even on the gassy basins, it's probably closer to PV10 to PV12. Buyers are not in just the economic strip right now of the NYMEX strip on gas or oil prices. It doesn't. Most wells are not economic to drill in this current environment. Some are barely, but when you're putting that money into the ground to get the money out at this strip at this pricing, buyers are unable to give you much value for your upside, for your proved undeveloped. But saying that, the buyers understand that if the price of oil or gas goes up by 10%, then this wedge of value magically appears. It's there. You can in your evaluation tools, you can toggle the price of a MCF or a barrel for oil, and you can see that this magically appears. The wells become economic. So buyers are really having to kind of jump over the perception and try to prove to the sellers that their offer is giving them some value for that upside. Sellers typically don't want to give things away. Why should they? There's value there, but so the buyers tend to, or what we've been experiencing lately, is the buyers that are trying to get deals done are trying to show to the sellers that they are in fact giving value for proved undeveloped locations, drilling locations, or upside.
Fantastic, thank you. And then we've got about 9 minutes, folks. If you have any questions, please get them in. Don't be shy. So speak to some of the different strategies companies pursue: unconventional shale versus conventional, PDP heavy, non-op, working interest, royalties, minerals, acreage, et cetera, et cetera.
Yeah, and I guess the way I would think about describing this is if you're going to, you can go into the oil business and you can use your own money, but you have to be pretty wealthy to do that. And the price of poker has gone up substantially, in the past 10 years. So, if I were come from a wealthy family and my dad said, Chris, you just turned 43 years old today, and the trust says we're going to give you $30 million. I would say, Dad, man, that's only like 3 wells. I can only drill 3 wells with that. That's not my oil empire. I can only drill 3 wells. I need way more money than that. So talking about the strategies, you have to, it's very expensive to play the game. So, if you're going to raise money, you have to, convince someone that has lots of money, a private equity sponsor, NGP or NCAP or Warburg or KKR or whoever, a wealthy family office. You have a unique strategy. So many of the companies that raise money will do so by saying, we're going to buy non-ops in the Permian Basin. There's companies that have non-operated working interests. They don't want to pay the AFEs for the authority for expenditure to drill the wells because they're expensive, but we're going to do that, and we're going to make our money off that. Or we're going to buy royalties because we have unique knowledge of the Oklahoma area, and we have access to all these owners, and that's what we're going to do. Or, we have tons of geologists and engineers, and they're very skilled in South Texas or the Gulf Coast basin, so we're going to drill inexpensive wells that produce a lot. And that's going to be, I guess, all these different entities and organizations and people have, multiple different strategies on how they're going to, how they're going to make money, how they're going to turn $1 into 5.
Okay, fantastic. And then, Chris, if you don't mind sharing your information just before, with a few minutes. I don't want to wait right till the end. And then I've got, so how do capital markets affect upstream A&D, and what's going on in the capital markets right now?
Right. So many the capital markets are strained right now. That there's not access to investors. Generalist investors are not putting money into oil and gas right now for a variety of reasons. One, it may be environmental, social governance reasons. They think that oil and gas is bad for the climate, so they don't want to invest Harvard's money or Yale's money or whatever, their pension fund into something that potentially pollutes the climate. And secondly, the show is called Show Me the Money. So many of these investors put money into oil and gas, and they didn't make any money. They put money into big companies, in the Delaware Basin, in the Permian Basin, in the Utica, and they invested that money and they didn't get any money back. So those investors were burned, or there was a lot of bankruptcies. So they're kind of burned, and then you get burned 3 or 4 times, and you don't want to invest in that anymore. So the capital markets, debt, equity for oil and gas ventures has been really strained because of, it was kind of the executives won, or the team won for a couple years and then didn't. So I think that there's going to have to be a lot more capital discipline, and just doing the right things, the right money, and paying the investors back for a period of time. I don't think by any means the oil and gas industry is going away. It's not. It will be here for many, 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 many years to come. But I do think that investors have been burned by the promises of, the shale technologies and things like that. I think that we're going to have to entice those investors back, and by doing so, enticing those investors back means, making them money.
Sure. And so, how do you think, and do you think that, if some of these companies that were, doing the investing had more kind of geologists, geoscientists in the room when they were, looking at some of these, opportunities, you think that they probably would have made better decisions?
I don't know. Incentives are a very powerful thing. Getting a promotion, or getting a bonus, or getting the next job, or being the engineering firm or geology firm that says, rubber stamp something and says, yes, I believe in that, can have implications. I think there was a lot of the naysayers weren't rewarded, I guess I would say. So if you were the naysayer and you said that's not going to work, maybe you weren't on the next deal team. So I think it had its social effects to it. Not that anybody was wrong or somebody. People have different opinions, but sometimes people with the purse strings are looking for not the right answer, but their answer.
That sounds, I'm not going to say that on this call, but it sounds like somebody I know. Anyways, so this is from Henry Daha. I guess taking assets through bankruptcies competes with EnergyNet. What's the percentage we have seen this year and last for getting assets through bankruptcies versus EnergyNet? Anything EnergyNet can do to increase its share before they go to the bankruptcy courts? Good question, Henry.
No, it's an interesting question. Our firm specifically handles asset divestitures for our clients. Many times when a entity is facing financial distress, an oil and gas company is facing financial distress, they hire a different type of firm to look at all kind of a broad range of options of saying, we're going to restructure your debt. We're going to, the guy that you owe $100 to, we're going to see if he'll take $50 worth of equity. We're going to try to find a JV partner for you. We're going to try to get somebody to buy it. All these 10 different options, and asset divestitures are one of them. So when they don't find one of those 10 other options, 9 other options, and they sell the assets, So that somewhat competes with EnergyNet. We facilitate bankruptcy sales, and we continue to do so. We've probably done, I don't know, 35 or 40 since 2015. We've done three this year, and have more in the pipeline. So we run the sale process for the assets in bankruptcy. Many times that's done by a larger investment bank or a restructuring firm. And we sometimes work alongside of those people to help facilitate the sale process and run a competitive process. You would think that companies that are in financial distress, that are on the ropes, would want to sell assets to raise money. Sometimes they can, many times they can't, because it further reduces their borrowing base, their lending requirements. So, it's like their collateral to get the loan was predicated on this asset that they owned or assets that they owned. By selling that, what are they going to do with that money? Are they going to pay back the lenders? Are they going to pay back a portion of it? Are they paying? So most of that, a lot of times, that has to get dealt with or discussed or adjudicated in a court, in a bankruptcy court.
Sure. So I want to get two more questions at 7:30. The final question is, and I'll let you think about it, is what will you tell, what advice would you give to a young person getting into the industry? The penultimate one will be, this is from Alan Batain again, a money person, a game show question, I guess. A money person told me recently you'd be better off getting your money on a credit card and paying 25% interest than taking private equity money. What do you think of that, at least in principle, if it were easily available?
Private equity serves its purpose and can be used in particular ways. I think our industry was kind of caught up. I know that I have friends that are my peers and contemporaries that were sponsored by large private equity companies. They took private equity money. It seemed like a lot of money. They had a big swing at the plate, to make something big happen. Some of them did, some of them didn't. Some of them are retired right now, which they show the lottery winners with their big check on TV. They don't show necessarily all the other people that bought the ticket. I think some people, professionals, saw so many people getting private equity sponsorship money, and it just sounded, wow, I can work with three of my good friends that I trust and I love to work with, and I think we have great ideas, or I can work for some mega corporation where, nobody knows what I'm doing or why I'm doing it, or I don't really serve a purpose. It just seemed more entrepreneurial. But, some of those panned out, some of those didn't. I think that private equity definitely serves its purpose, and you can make great things happen with it. There are, if somebody's going to give you $100 million, there's some strings attached usually. I think in any situation there would be. To your last question, as Susan said, and in her presentation, I'm a big proponent of networking and being involved in organizations, helping the industry and just, helping people. Many of the things that you would categorize your best friends in life or your loved ones and how they act towards you, or how they treat you, or how, if they help you or not. Do that with your business associates, and be of value to people and help them when they're in need and help them when they're not in need. And be curious and be attentive, and all those things. It is a big community, and it's you run into the same people again and again and again in the industry, and it's great if you did them a favor or did them a solid 15 years ago, and they remembered that, or they remembered you put in a good word for them, or you referred them for a job, or told them about a job that was available, told them about a deal. If you have, as Susan mentioned, there's kind of this rule of reciprocity, that you're always helping people in some shape. Maybe it's small, maybe it's big, maybe you don't think it's anything, but if that's just kind of your rule of how you walk your life, then it's going to come back to you.
Fantastic. So I want to invite Susan back on. I really want to thank both of my speakers, and I just want to say, So Casey asked me to help him out with this, and initially I was reluctant, and then I was like, okay, sure, I'll go ahead and do it. But I'm really enjoying the things that I'm learning. Like, I feel like, every month or every 2 weeks, I get, a mini MBA from some really, experienced, educated, but I think the experience tops the education every single time. You go to school, you learn something, but the experience that you pick up, that life experience, it's so invaluable, and you can't, unless I read your biography, you can't get that in a book unless, of course, again, I read your biography. So we really thank you for, investing forward and paying it forward to the industry. Houston Geological Society and the NeoGeos really appreciate you. Folks, if you want to, connect with these folks, as you can tell, they're very open to network. They're very open to helping people. I would suggest you take what they both said and see how you can help them. You may think, well, how can I help them? You just never know. So, but at least offer it, and you never know what might come of it. Maybe a friend who's in need. It might not be you. Introduce your friend to these folks, because it's not everyone that's open to kind of, like they said, networking and helping people. And obviously the two of these folks have taken the oil and gas industry and turned it not into a job, not even into a career, but I don't want to sound too wormy squirmy or whatever, but they turn it into family. And you can tell from just the way Chris delivers his answers, and just the way Susan, how she's, managed her career, and she's fully committed to the industry. And so if you want to stand out, if you want your friends to stand out, those are the things that you're going to have to do. So once again, thank you very much. We all appreciate you. And until the next, show me the money. All right, folks, we'll have a good one.
Thank you, Casey. Thank you, Susan. Thank you, Josh. Thank you, everyone.
All right,
Thank you. Bye.
Funny. I couldn't help it. Someone said game show, so. All right. Have a good one, everyone.
Goodbye.
Bye-bye.